So diving into this, have you ever felt, a bit lost looking at a company's financials, trying to figure out how their reported profits stack up against the actual tax they pay?
Mm-hmm.
Or maybe you've wondered why a company sometimes seems to owe tax in the future for something that happened today.
Yeah, that's a common one.
Today, we're embarking on a deep dive into something called deferred tax. It's a topic that, well, might sound complex, but is absolutely crucial for understanding corporate finance.
Right. Our mission for this deep dive is to truly unpack IAS 12. That's the International Accounting Standard governing income taxes for companies.
Okay.
We'll try to strip away some of the jargon, bring these concepts to life with real-world scenarios, and reveal how deferred tax fundamentally shapes the story a company's financial statements are actually telling you.
Think of this as your express lane, sort of, to becoming truly fluent in this often misunderstood area, uncovering not just the what, but the why it matters.
Exactly. For investors, analysts,
or anyone just curious about how companies really manage their books. We're talking surprising facts and insights that will help you become well-informed, quickly and thoroughly. So let's get started.
Okay, let's unpack this then. At its core, what exactly is deferred tax, and why is it such an essential part of a company's financial picture?
Well, at its simplest, deferred tax represents the future tax consequences of past transactions. It's fundamentally about the income tax a company expects to pay, or sometimes save in future periods.
Okay, future tax.
Specifically on its corporate profits or losses. And IAS 12 steps in because, you see, the rules for accounting for profits are often different from the rules tax authorities use for calculating the tax on those profits.
Ah, so that difference is key.
Yes, it creates what we call temporary differences.
So it's really about those timing differences, isn't it, between when something hits the books for accounting versus when it's recognized for tax purposes.
Yeah.
Can you clarify what exactly a temporary difference is? That's precisely it. A temporary difference is basically the mismatch between an asset or liability's carrying amount. That's its value in the financial statements, its book value, essentially.
The book value.
And its tax base, which is its value as recognized by the tax authorities. They're called temporary because they will eventually reverse over time.
Okay.
And these differences can be taxable, meaning tax will be payable in the future when that difference reverses, or they can be deductible, which leads to a tax saving or deduction down the line.
And IAS 12 isn't optional here, is it? It sounds like companies have to account for this.
Absolutely mandatory. It mandates that companies must record a deferred tax liability for all these taxable temporary differences that exist at the year end. This is a crucial point because it means the balance sheet has to reflect these future tax obligations or potential assets in the case of deductible differences.
This terminology, carrying amount, tax base. Yeah. It can still sound a bit abstract, so maybe an example would help. I know depreciable assets are a really common one.
Yes, perfect example.
How do these everyday assets create these temporary differences you're talking about?
Right. So companies depreciate their non-current assets, think machinery, buildings, that sort of thing, over their estimated useful life in their financial statements. That's accounting depreciation.
Standard stuff.
But for tax purposes, governments often allow something different, usually called tax depreciation or sometimes capital allowances. And these tax rules might allow for faster depreciation, especially in the early years, maybe to encourage investment.
Okay, so the rates differ.
Exactly. When the accumulated accounting depreciation and the cumulative tax depreciation aren't the same at year end, the asset's carrying amount, its book value, will diverge from its tax base. And boom, there's your temporary difference.
Let's put some numbers on it. Imagine a machine bought for, say, $2,000. On the books, simple straight line depreciation. $500 each year for 4 years.
Okay. 4-year life, $500 a year.
But for tax, let's say the government allows $800 in year 1, then $600 in year 2, then it drops to $360 and finally $240 in year 4. Adds up to $2,000 still, but front-loaded.
Right, a common scenario. So what happens is, in those early years, year 1 and 2, the tax depreciation you claim, $800, then $600, is actually more than your accounting depreciation, $500.
Which means lower taxable profit initially.
Precisely. Your taxable profit is lower, so you pay less tax now. But this creates that taxable temporary difference. For instance, after year 1, your accounting book value is $1,500, $2,500, but your tax base is only $1,200. $2,800. That's a $300 difference.
I see. And that difference grows in year 2.
Yes. In year 2, the carrying amount is $1,000. The tax base is $600. $1,200, $600. The difference is now $400. It grows initially, then it starts shrinking in years 3 and 4 as the accounting depreciation overtakes the tax appreciation.
And what's really insightful here, I think, is that over the asset's entire life, the total depreciation is the same $2,000 both ways.
Exactly.
So the tax isn't actually saved forever, it's just shifted in time. You got the tax relief early.
That's the perfect way to put it. In years 1 and 2, the tax authorities allowed more depreciation, giving the company a cash flow benefit. It's almost like an interest-free loan from the government.
Okay, an interest-free loan. I like that.
But because it's a temporary difference, that loan has to be repaid, so to speak. In years 3 and 4, the accountant appreciation is now more than the tax appreciation allowed, meaning the company's taxable profit is higher, and it effectively pays back that deferred tax. This confirms these are indeed taxable temporary differences.
So how does this accounting mechanism actually translate into what we see on the financial statements? Let's assume a simple tax rate, say 25%.
Okay, 25%. On the statement of financial position, what most people call the balance sheet, a deferred tax liability, is recognized based on that temporary difference.
Right.
So at the end of year 1, you have that $300 temporary difference. At 25%, that's a $75 deferred tax liability recorded on the balance sheet.
And where does the other side of that entry go?
Good question. That increase in the liability is also recognized as part of the income tax expense on the statement of profit or loss for that year. So it impacts the company's reported earnings.
Okay, so it hits both statements.
Yes. And as the temporary difference changes each year, it grew to $400 in year 2, remember?
Yeah.
So the liability needs to be $100, 25% of $400. Since we already had $75, we record an additional $25 liability, and that $25 increases the income tax expense for year 2. Then, as the difference shrinks in years 3 and 4, the liability decreases, and that decrease reduces the income tax expense reported in those years.
So these year-to-year movements in the liability are what flow through the income statement expense line.
Exactly. The movements go to profit or loss, while the closing balance sits on the statement of financial position. It ensures the income tax expense reported each period truly reflects the tax consequence of the economic activities recognized in that same period.
This annual adjustment, the movement, that seems to be where the real magic of deferred tax happens for understanding a company's true performance each year.
It is. And if we connect this to the bigger picture, while IAS 12 ensures the balance sheet reflects these future tax obligations, its impact on the statement of profit or loss is equally crucial for getting a holistic understanding of profitability.
Let's stick with our example. Suppose the company consistently makes, say, $10,000 in accounting profit before income taxes each year for those 4 years. That's after charging the $500 annual appreciation.
Okay, steady profit.
You might instinctively think, well, 25% tax rate, the income tax expense should be a flat $2,500 each year, right?
Logically, yes. But the actual tax paid, the current tax, is based on taxable profits, which we know are calculated differently because of depreciation timing.
All right.
And that's where deferred tax comes in to bridge that gap. For tax purposes, remember, you add back the accounting depreciation, $500, and deduct the tax depreciation, $800 in year 1, from your accounting profit, $10,000.
Okay, so $10,000 plus $500 added dollars, that's $9,700 taxable profit in year 1.
Exactly. So the current tax liability, the tax actually payable for year 1, is 25% of $9,700, which is $2,425.
Okay, $2,425 current tax. But we also had that $75 increase in the deferred tax liability going through the expense line.
Yes. So you combine the current tax liability of $2,425 with the $75 increase from deferred tax.
And you get exactly $2,500.
Precisely. The exact 25% of the $10,000 accounting profit before tax. And this works out every year. It perfectly illustrates the matching principle at work.
Wow.
The total income tax expense reported in each period genuinely reflects the tax consequences, the charges, less any relief of the income and expenses reported within that period's accounting profit, regardless of when the cash tax is actually paid.
That really clarifies the why. It makes the reported profit and tax expense figures more consistent year on year.
It does, though this raises an important point. What happens if a transaction, or maybe a gain, isn't reported in the profit or loss at all? Sometimes things go elsewhere.
Like where?
Well, sometimes gains or losses are accounted for outside of the main statement of profit or loss, maybe in other comprehensive income or even directly in equity.
Right, OCI or equity adjustments.
In those cases, IAS 12 is very clear. The tax effect must also be recognized in that same location. So if a gain hits OCI, the tax on that gain also hits OCI.
The tax follows the transaction's location. That maintains transparency.
Exactly. It ensures the tax consequences follow the underlying economic event, wherever it's reported.
Speaking of transactions outside profit or loss, are there other common scenarios where deferred tax comes into play? Maybe in ways that might surprise us or show a different side of things?
Absolutely. Revaluations of non-current assets are a really significant example of another taxable temporary difference.
Asset revaluations. Okay.
When a company decides to revalue an asset, like land or a building, up to its current fair value on the financial statements, that revaluation gain typically bypasses the profit or loss.
How does it go?
It usually goes directly into equity, into a reserve called the revaluation surplus, and it's reported in other comprehensive income, OCI.
Okay, so it boosts equity, not profit.
Right. But while the asset's book value dramatically increases, its tax base, what the tax authorities see, generally remains unchanged at its original cost basis, less any tax depreciation claimed.
So you get a big gap instantly.
A potentially huge temporary difference, yes, because tax will eventually become payable on that revaluation gain, typically when the asset is eventually sold.
And the key point here, based on what you just said,
the key is, since a revaluation gain itself was recognized in OCI and equity, the related deferred tax charge is also recognized there. It reduces that revaluation surplus balance directly in equity. It doesn't hit the main income statement.
So the balance sheet shows the higher asset value, but also the corresponding future tax liability, and the net gain in equity is already tax affected.
Precisely. It ensures the balance sheet paints a complete picture, reflecting the tax burden sitting on those unrealized gains.
Let's build on our earlier asset example then. End of year 2, remember, the carrying amount was $1,000, tax base $600, temporary difference $400. Now suppose right then we revalue that asset up to its market value of $2,500.
Okay, big jump.
How does this revaluation impact the deferred tax picture? What's the nuance here?
Right. So before the revaluation, our temporary difference was $400. Now the carrying amount jumps to $2,500, but the tax base is still stuck at $600.
So the temporary difference is now $1,900, $2,500, $600.
Exactly, $1,900. At our 25% tax rate, the required deferred tax liability at the end of year 2 is now $475, 25% of $1,900.
Okay, $475 total liability needed. It was $75 at the start of the year.
Correct. It was $75 at the end of year 1. So the total increase in the liability during year 2 is $400. $475 required now minus the $75 already there.
But here's the nuance you mentioned. Not all of that $400 increase hits the income statement.
Correct, because a huge chunk of that increase relates directly to the revaluation gain. The gain itself was $1,500, $2,500 value minus a $1,000 carrying amount.
Right.
So 25% of that $1,500 gain is $375. That $375 portion of the deferred tax increase bypasses the income statement and is charged directly against the revaluation surplus in equity.
Reducing the surplus from $1,500 down to $1,125, $1,375 on a net of tax basis.
Exactly. The remaining increase in the deferred tax liability for the year. Well, remember, the liability would have gone up by $25 anyway, just due to the normal depreciation difference in year 2.
Yes, the difference went from $300 to $400, so the liability needed to go from $75 to $100. That's a $25 increase.
That $25 increase, related to the normal operations reported in profit or loss, is the part that gets charged to the income tax expense line for year 2.
So the total $400 increase in the liability is split. $25 to income tax expense, P&L, and $375 against the revaluation surplus, equity OCI.
Perfect. You'd see the journal entry reflect that split. Debit income tax expense, $25, debit revaluation surplus, $375, and credit deferred tax liability, $400.
That's a fantastic illustration of how the tax consequences rigorously follow the underlying transaction wherever it's recorded.
It really is fundamental to understanding IAS 12.
We've certainly taken a comprehensive deep dive today. We started by, defining deferred tax, walked through that detailed depreciation example, saw how it affects both the income statement and balance sheet.
The matching principle in action.
And then explored its crucial role in more complex scenarios like these asset revaluations, especially how tax follows the gain into OCI or equity.
Yeah. The goal here wasn't just to present the mechanics, but hopefully to help you grasp the underlying logic and purpose of deferred tax accounting.
Which is?
It's really about ensuring a company's financial statements accurately reflect the true tax consequences of its activities, matching income and expenses with their related tax effects, even if the actual cash payment is deferred into the future. It gives a much more faithful representation of a company's financial health over time.
So, thinking about all this, what stands out to you about how companies manage their tax obligations over time? And how might this understanding change how you, our listener, interpret their reported profits and financial positions?
That's a great question to ponder.
Consider how these temporary differences could maybe be strategically managed by companies, perhaps to optimize cash flow, or how analyzing these deferred tax balances might signal different business strategies, maybe even future financial pressures.
Absolutely. Does it tell you something about their investment cycle or their expectations about future profitability?
What new questions does this raise for you about how companies truly report their financial health beyond just the headline profit numbers? We definitely encourage you to keep exploring.